the Junior Economic Club is honored to have Gus Faucher, the chief economist at PNC Financial Services, here. The Junior Economic Club was founded in 2014 and is an entirely student-run nonprofit that fosters a community of driven high school students and business leaders. JC offers students exposure to business and economic concepts that are not taught in school, and the club has over 100 students representing 25 high schools across Chicago, as well as chapters in 9 cities across 4 countries. And you can learn more about the club and its admissions at junioreconomicclub.org/home. So, and then okay, so you should be able to see my screen now.
Yeah.
So Mr. Faucher is he's the chief economist at PNC Financial Services. He earned a PhD in economics from the University of Pennsylvania and a BA in economics from Cornell University. In addition to being the chief economist, he is also on the board of directors at the Economic Club of Pittsburgh and in the a co-chair of the National Association of Business Economics Financial Roundtable. He has past experience as a director at Moody Analytics, as a senior economist at the US Treasury Department, and as a UIUC visiting lecturer. And with that, Mr. Faucher, if you'd like to get started with your experience.
Okay. Yep, thank you very much, and I'm sorry for the hassle. I'm actually coming back from a week of vacation, and so I'm driving, and I was up in the hills, and so I lost the signal. So I'm sorry about that, and that's why I'm not coming to you via video. I'm actually, in my car right now. So let me tell you a little bit about how I ended up becoming the chief economist at PNC, and then we'll talk about the economic outlook, and then I want to leave lots of time for your questions because there's a lot going on. When I was in high school, I actually did not take any economics classes. So they did offer AP economics at my high school. I went to a suburban high school outside of Philadelphia, but I did not take that class. But that being said, I did have a number of friends who had parents who were economists, either professors or worked for consulting firms or whatever. So I was exposed to economics as a kid, but had not taken any classes. As Leo mentioned, I went to Cornell University, and I did take the introductory macro and micro classes while I was there, and I really enjoyed them, and decided to become an economics major, but was not planning on having a career in economics. So I was an economics major. I enjoyed my economics classes. I was good at it. It was something that I felt very, very comfortable doing. And then my senior year of college, literally at the end, when I was taking my exams at the end of my senior year, I had one of my professors ask me what I was going to do.
Economist.
One of my professors said, why don't you think about getting a PhD in economics? And when she said that, it was like the light bulb going off over my head. And I thought, well, that's a great idea. I can become an economist. So I took a couple of years off after college, but I got married and then applied to graduate school. And so I started at the PhD program at the University of Pennsylvania. My wife started medical school in Philadelphia at the same time. So we moved back to Philadelphia where I was from. And so I went on to get a PhD at Penn. Graduate school in economics is very, very difficult. It's certainly not something that you can just do if you think that you might be interested in economics. You really have to be dedicated. And it was, I'll be honest with you, it was a very, difficult time, a lot of hard work, but I persevered and got my PhD in economics. I did teach at the University of Illinois at Urbana-Champaign for a year. I was a visiting lecturer there in the Department of Economics and the Institute of Labor and Industrial Relations. I should back up and explain that my dissertation was actually on a labor economics topic, looking at labor markets. I taught at UIUC for a year, which was a very good experience, but that was just a temporary position. And then I got a position at the US Treasury Department in Washington, D.C., and I was there for 6 years while my wife did her residency in family medicine. And that was a very interesting experience. I got to work with some fantastic economists who were, frankly, some of the best economists in the country, who working with the Clinton administration. I worked in the Clinton administration and then the first part of the George W. Bush administration. And that was a great experience. I learned a lot about how to be an economist. I did some micro, I did some macro. But I got tired of living in DC. My wife wanted to explore different career opportunities. I wanted to try something different. So I worked for a consulting firm called Moody Analytics outside of Philadelphia. Started that in 2001. They do consulting for businesses. They do consulting projects. They do a lot of regional economic analysis. So talking about what's going on in the Chicago area economy based on national trends, or they might cover smaller metropolitan areas like, Peoria or Springfield, Illinois, or something like that. They covered every single metropolitan area in the country. I wrote about fiscal and monetary policy, so what the Federal Reserve was doing, what the federal government was doing. And then after a few years there, I took over running the firm's computer model of the U.S. economy. So that allows you to make assumptions about what's going to happen with fiscal policy, what the federal government is going to do, what the Federal Reserve is going to do. And then, that model produces thousands of economic theories. So what's going to happen to inflation? What's going to happen to the unemployment rate over the next 4 or 5 years? What's going to happen to GDP, and the components of GDP? So if you think about the C plus I plus G, what's going to happen to consumer spending, business investment, that kind of thing. So I ran that computer, that was a big part of my job, was running that computer model. I also edited a publication on the U.S. Economic Outlook every month, kind of their flagship publication, saying, hey, here's where the U.S. economy is going to be going over the next few years, talking about housing markets, the labor market, consumer spending, and how all of those pieces fit together. So I did that for about 10 years. And then I was not looking to leave the consulting firm, but the man who was the chief economist at PNC at the time called me and said, I'm going to be retiring in a few years. We would like you to come to Pittsburgh, and we can't make any promises, but the expectation is that when I am done being chief economist, you will become the chief economist at PNC. PNC is actually, we do have locations in Chicago. I was actually on a call with some of our Chicago clients on Thursday, but it is one of the 10 biggest banks in the country. It's what's called the super regional bank. So we have locations in the Northeast, the Southeast, and the Midwest, and then we are expanding to some other markets on the West Coast and in further west, Denver, Kansas City, Texas, Pacific Northwest, that kind of thing. And so the opportunity to be the chief economist at a top 10 bank, that was really too good to pass up. And so I moved with my family to Pittsburgh. My wife she directs the residency program for family medicine. So she teaches the younger younger people who are just getting out of medical school and are learning to be family physicians. We have 4 kids. So at the time we moved, we had 3 in high school and 1 in college, and we now have 3 in college, 1 out of college, 2 in college, and 1 in high school. We're a few years ago, I was appointed chief economist at PNC. What that means is that every month I produce a forecast for the U.S. economic outlook that covers the next 5 years, so where the U.S. economy will be through 2025. We actually use, my old companies, they have an online computer model of the U.S. economy that I use. We also produce write-ups on the U.S. economic outlook every month. And so when I get back to the office on Monday, I'll be wrapping up our July write-up. We produce write-ups on the data. So we talk about if we get the jobs report, what does that mean for the U.S. economic outlook? The GDP report, the second quarter GDP report will come out Thursday. That's very important because that will figure out most of what's been going on with COVID, will tell us how much the economy contracted because of COVID. And so we'll be looking very closely at that. I do media interviews. I actually did one with WBBM in Chicago. Their noon business hour, I was on there on Thursday. I talk with them a couple times a month. I may do TV interviews on CNBC or CNN or, national radio networks, public radio, that kind of thing, or talk with someone from the Chicago Tribune about either what's going on with the national economy or what's going on with the Chicago area economy. And then I also speak to clients at PNC. They may have questions, particularly in the current environment, about what's going on, what the U.S. economic outlook is, all of those kinds of things. And so that's a big part of what I do. So some of it is internal to PNC. We also produce economic scenarios. The Federal Reserve wants us to make sure that in the current environment, that PNC is financially stable, that we have enough capital, that we won't need to get bailed out by the federal government, which is what happened a decade or so ago in the Great Recession. Not PNC, but other banks, had to take money from the federal government so that they could stay in business and continue to lend, because that's very important during a recession. And so that's a big part of what I do, is developing economic scenarios so that we can make sure that PNC has enough capital to survive a downturn. So let me stop there, take a break. Do you have, and then I am going to talk about the economic outlook, so don't ask any questions about that. But if you have questions about how one becomes an economist, what I do as an economist day to day, that kind of thing, why don't you go ahead and ask that now? And then when you do ask a question, do me a favor and please state your name and where you go to school.
Yeah, so our members submitted some questions ahead of time about your personal experience. So
Okay.
I'll run through those, and then if anyone has any questions that weren't mentioned, they can ask.
Mm-hmm.
So the first question you kind of answered,
Right.
what you do as an economist for a bank. What have been some of your most difficult challenges as an economist, and what have you learned from them?
So I'll give you two answers there. The first is particularly PNC has 50,000 employees. And so, people have views on the economy, including people who are, that I report to. So my boss or the CEO will have things. So when I do the economic outlook, I have to take all of their views into account, because when I speak as the PNC chief economist, I'm speaking for the entire organization. And so there may be times when I have a view as an economist that other people have a different view. And so they may, I have to try to figure out how much to incorporate of their views and how much of it is to incorporate of my views, so that I have a forecast that I feel comfortable putting my name on and saying, this is PNC's forecast, but as the chief economist for PNC, I stand behind that. The second thing is, the current environment is incredibly difficult. We have never, as an economy, been through an experience like this, and I'll talk about that. But we're kind of, when we're doing a forecast for how the economy is going to look a year from now, we have to make a huge amount of assumptions about what the path of the coronavirus is going to be, how much is going to impact consumer spending, business investment, the labor market, the international economy, and therefore U.S. trade, all of those kinds of things. And so, we had to basically in March and then again in April and May, we basically had to throw out the forecast that we had and build it from scratch and make a lot of assumptions about where things are going. If you think about, and I don't know how many classes you guys have had, but GDP, output of goods and services in the United States, basically the size of the U.S. economy, that is consumer spending plus business plus investment plus government spending plus net exports, so exports minus imports. And so I have to, when this all happened, I had to make huge assumptions about, well, how are consumers going to be spending during the stay-at-home orders, and then as those stay-at-home orders are lifted? How are businesses going to respond in investment? What is the path of government policy going to be? Tax cuts, spending increases, all of that kind of thing. And then what's going to happen to the trade deficit? What's going to happen to the global economy? So, I've had to basically rethink my entire view of where the U.S. economy is going. Now, I find this really exciting as an economist. I'm kind of a geek that way. But, I have an entire organization of 50,000 employees that to some extent is depending on my forecast. And so I've had to really think things through about what's going on, and, where we think the U.S. economy is going. And then I have to be, when I go out and talk about it, when I talk about it with people like you, there's just a huge amount that we don't know. And so I have to be very clear in communicating the huge amount of uncertainty that exists around our forecast right now.
Okay, thank you. That was very insightful. The next question we had, what skills should students pursue to deepen their understanding of and get involved with business and finance during this time?
What I will say is, and I think this is true for economics, particularly if you think you might be interested in graduate school in economics, take a lot of math classes. If you think you might be interested in getting a PhD in economics classes, obviously, there's economics involved, but a lot of it is math. And that's also true for people who are interested in business careers or finance careers. The other thing is that, think about writing is incredibly important. So much of what I do is writing about the economy. So it's important that a good writer and can present my ideas clearly. So take writing classes in college, which you may not think are going to communicate. Those are things that I would. Focus on as you think about a potential career. But that what I would also. Sorry, I think I lost you for a second. You good?
Could you repeat what you said over the last minute or so? We couldn't hear.
Yep. Sure. Sorry about that. So I think the skills as an economics major, how to think through problems, how to figure out what's important and what's less relevant, what the key things are. I think being an economics major is useful in many careers, whether it's going to be in business, in law school. Certainly not just if you want to get a PhD in economics, but if you're thinking about public policy, an MBA, all sorts of fields that I think being an economist is very can be very helpful for.
Okay, thank you. If anyone has any other non-COVID related questions, go ahead and ask them. unmute yourself and yeah.
Hi, my name is Marga. I'm a rising junior at Whitney Young Magnet High School. My question is, how has economics changed the way that you think and analyze aspects like money or cause and effects or like the outcomes in like everyday life? How has it like changed your thinking or affected your thinking?
You know, in this is good and bad. I tend to think about things in an economic manner, and my wife would tell you that in some respects that's not a good way of thinking things. But I think through, I mean, part of it is financial decisions and thinking about how to save for retirement and investment strategies and all that kind of stuff. The other thing is that when I tend to think about things in my family life and my personal life, I do it from kind of a cost-benefit analysis. You learn about opportunity cost, which is the foregone cost of taking that. If I go to college, that means that I won't be making money working for 4 years while I get a college degree. But on the other hand, at the end of the process, when I have my college degree, I'll have higher earning potential and things like that. So I tend to think of things. I mean, I'm a very analytical type of thinker, which is good for an economist, but not necessarily good when you're dealing with your family and trying to, come to an agreement with your kids or something like that.
Thank you.
Mm-hmm.
Okay. So now, if you wanted to talk a little about the current economic outlook with COVID and all.
Yeah. Again, so let's go back and I don't know how many economics classes you all have had, but if I was talking about GDP, which is output of goods and services in the economy, that's the broadest measure of the size of the economy that we have. That is, it is the sum of consumer spending plus investment plus government spending plus exports minus imports. And so when we think about the impact of COVID-19 on the consumer spending accounts for about 2/3 of the U.S. economy. So obviously consumers in many aspects have been unable to spend. I can't go out to the store and purchase some of the things that I normally would purchase. I'm not going to restaurants. I'm not going to movies. On the other hand, I'm spending more at the grocery store because I'm going out less. Maybe I'm spending more on streaming video services. I'm not going to get on a plane. So when we think about the impact of COVID-19 in the economy, we have to make assumptions about how much less consumer spending is there going to be, how much less business investment is there going to be. On the other hand, we're going to see the government increase its spending. It's making transfer payments. It's paying extra in unemployment insurance, both because people are unemployed, but also because the government made more people eligible and are paying beneficiaries, unemployment and insurance beneficiaries, an extra $600 a week, although that's set to expire at the end of this month. So we need to put all of those things together and make assumptions. And right now, and we don't have the final numbers yet, and we'll get at least a preliminary read on that, we expect that the U.S. economy is going to contract by about 12% between the end of 2019 and, roughly the enormous contraction in the U.S. economy. It's much greater than the Great Recession that we had about a decade ago when the economy contracted about 4% over a period of a year and a half. Now we're talking about a contraction of 12% over a period of really about 3 or 4 months. So really an unprecedented contraction in the U.S. economy. We saw the U.S. economy lose about 22 million jobs in between February and April. The unemployment rate rose from 3.5% to almost 3.5% in February to almost 15% in April. me, in the 1930s. And so we've had an enormous dislocation as consumers have been unable to spend, as people have been unable to get to work, as businesses have been reluctant to invest because they don't know what demand their goods and services going forward. That being said, we have started to see the beginning of 7.5 million jobs over the past couple of months. That's replaced about a third of the jobs that we lost initially because of COVID-19. We've seen the unemployment rate fall from close to 15% to around 11%. So definitely doing better there. We've seen consumers start to spend again. And part of that is because the federal government has stepped in and has provided extra unemployment insurance benefits. The federal government provided a lot of households with extra tax relief. So they basically mailed checks to hundreds of millions of households that allowed them to increase their spending even if they lost their job. And so we have seen areas of the economy over the past couple of months. There are other areas where we still see significant contraction: travel and tourism, air travel, hotels. Obviously, people aren't going to sporting events or movies or plays or concerts or things like that. But other areas of the economy are doing better, where we're starting to see some activity come back. That being said, it is going to be a long road back for the U.S. economy. I think that the unemployment rate will probably not fall below 10% until the end of this year. The unemployment rate will probably be around 7.5% at the end of next year, and maybe around 5.5%, 5% at the end of 2022. But remember, it was 3.5% at the beginning of this year when all of this started. We probably won't reach the same number of jobs that we had in the U.S. economy for a few years. It's going to be a very long road back for the U.S. economy. And then also something that I want to mention is we've also seen efforts by the Federal Reserve, the central bank of the United States, to support economic growth. Now, obviously, the Fed can't do anything about the virus or the pandemic, but what the Fed can do to stimulate the economy is to reduce interest rates. So they cut short-term interest rates in the United States basically to zero. They've also reduced long-term interest rates in the United States. So the rate of interest that businesses pay to borrow for their investment projects, or, for example, a mortgage. If you get a mortgage loan to buy a house, last week the interest rate on a 30-year mortgage, so a 30-year loan to buy a house, that fell below 3% for the first time ever in U.S. history. So you can borrow, if you're a consumer and you have good credit, you can borrow for 30 years at a 3% interest rate. And that has really supported the housing market. And in fact, we've seen housing sales come back. We've seen home construction come back lately. And we really expect that the housing market is going to be a key driver of the recovery in the United States over the next couple of years. So, it's going to be a difficult time back for the federal government, for the U.S. economy. One thing I am concerned is that some of the federal stimulus is expiring. So as I mentioned, people got expanded unemployment insurance benefits that allowed people who lost their jobs to continue to spend, but some of that is set to expire at the end of this month, so I'm concerned that consumers could cut back. And remember, consumer spending makes up about 2/3 of the U.S. economy. Now, there is talk of continuing those benefits. There's talk of additional stimulus payments to households and so forth. But I think at this point, it makes a lot of sense for the federal government to basically to borrow at very low interest rates and to provide money to households, provide money to businesses so that they can continue to spend. Sorry about that. Continue to spend. The federal government has provided programs for small businesses so that some of the small businesses that may have been forced to close could stay open, keep workers on their payroll, and then hopefully restart as we allow more consumer activity in the U.S. And then I think the most important thing, which is not an economic issue but a medical issue, is to contain the virus. Obviously, if consumers don't feel comfortable going out, We see consumers staying in, being cautious. So the most important thing we can do to support a strong economic recovery is to have, quick progress on a vaccine, quick progress on containing the pandemic so that people do feel comfortable going out and spending. Businesses feel that this will end and that they can invest again. And so that's the most important thing that we can do in ensuring a strong economic recovery in the United States. So that's and I'll tell you what, that's the exact same answer that I give to our executives at PNC. That's the exact same answer I give to our clients at PNC. So that's our U.S. economic outlook. And once we wrap up the call, I'll send in some information to Leo that he can share with you as to where you can find our write-ups and so forth. But at that point, let me stop there and ask what questions you have about the U.S. economy and where we expect the U.S. economy to go over the next couple of years. And I know, Leo, that you did have some questions that people had already submitted.
Yeah, so we'll start with, let's see, what are the parallels between the Great Depression and this recession? Mr. Faucher?
Yeah, and I'll be, yep. And I'll be honest with you, there aren't a lot of parallels. The Great Depression, first of all, the U.S. economy just structurally was very different. That we're talking 90 years ago. The U.S. economy was structurally very different. It was much more heavily dependent on agriculture, much more heavily dependent on manufacturing, much less dependent on service industries. You think about all the technological changes that have happened. So for one thing, the structure of the U.S. economy is different. The second thing is that the Great Depression was caused by problems in the economy at the time. Well, some of it was external in terms of the Dust Bowl and reduced agricultural output and things like that. But it was also caused by, problems in financial markets, the stock market, and you think about Black Friday and the big crash that they had in 1929. That there was a lot of debt that businesses and consumers had taken on, and that was part of the process. This was caused by something that was completely external to the economy, and that's very different from any other recession that we've had in the United States. Typically, recessions in the U.S. are caused by problems we developed imbalances in the economy. So probably you guys are too young to remember that the Great Recession a decade ago, that was caused by problems in the housing market. We built too many houses. House prices got too expensive for incomes, and so that caused huge problems in the housing market, and then that spread to the financial system. We had a recession at the beginning of this century that was caused by a tech bubble. Tech stocks were way, way overvalued. We had a big crash in the stock market, particularly in tech stocks, and that led to a recession. We had a recession in the early 1980s. It was caused by very high inflation, which is, prices were going up on average, 15% a year. And we saw the Federal Reserve raise interest rates to slow inflation, but that caused actually two recessions in quick succession. This time around, the recession was caused by something external, by the pandemic. And so we really don't have a good template for how this recovery is going to proceed, because so much of it depends not on the economy, but on the pandemic, on consumer psychology, and so forth.
Okay, thank you. And then the next question.
Okay, Leah, do we have another question there?
Yeah, what are your thoughts on the CARES Act and a potential second stimulus package?
So I think the CARES Act, as I mentioned, has been very important in supporting the economic recovery, both what we call the Paycheck Protection Program, which was designed to provide aid to small businesses. It's loans, but those loans will turn into grants, basically the government giving small businesses money if they stay open and keep their workers on. And so that's helped a lot of small businesses. We may need more small business assistance because some of these shutdowns are lasting longer than were expected. And as I mentioned, the other stimulus that supported consumers, the expanded unemployment insurance benefits, the tax payments to households, those have been vitally important in keeping consumer spending going forward. And I think that we are going to need more stimulus. I think that we need to provide more unemployment assistance, because there's still tens of millions of people out there who are unemployed because of the pandemic. And if they don't get extra assistance, they're going to have to cut back on their spending. And I think we certainly should take a look at whether we need additional stimulus payments, those payments that many households receive, to allow low and middle income households to keep their spending going, because if we don't, if consumer spending collapses, then that would be disastrous for the U.S. economy.
Yeah, definitely. And then on a related note, what are your thoughts on the actions that the Federal Reserve has taken to address COVID-19?
Yeah, so I mentioned, they're, short-term interest rates, they've cut long-term interest rates. They've also made sure that businesses can continue to get access to credit. So this is something, and I talk occasionally with Fed officials as part of my job, but this is something that they have said is vitally important. What they said is that they don't want what is a liquidity crisis, a short-term inability of businesses to get access to cash, to turn into a solvency crisis.
Next question. What are the major disputes among economists regarding the government's role in dealing with the economic effects of COVID-19?
I'll be honest with you that there's not a lot of dispute among economists right now. I think that whether we're talking about liberal economists or conservative economists, that we agree that the main course of action, first of all, is to get the pandemic under control. The second thing is to provide fiscal stimulus to the economy. And even economists who are concerned about the budget deficit and the national debt are saying this is not the time to worry about this, that we need a strong economic recovery. And so that we should worry, if we are concerned about that, we should worry about the consequences of that in a few years. Some people may have different opinion about the relative importance of various aspects, whether it's more important to aid small businesses, whether it's more important to aid households, that type of thing. Oh, and one other thing that I do think that economists agree on is that state and local governments are going to need a lot of assistance. So I know that Illinois, for example, has had big budget problems earlier this year. Not over the past number of years. But if you think about state government, they get a lot of their money from sales taxes. They get a lot of their money from income taxes, but those revenue sources are going to be way down because consumers are spending less, people are making less money from the job market, and so that we need additional aid from the federal government in order to help state and local governments get through the worst of this crisis. Because the concern is that if state and local governments need to make big budget cuts, make big job cuts, that would harm the economic recovery and make it much slower than it would otherwise need to be.
Great, thank you. And then when a vaccine is produced, how long will it take for the GDP and employment to rise back to pre-COVID levels?
So our view is, and we're assuming that we get a vaccine sometime in the next, let's say 9 to 12 months. That we would expect to see GDP to get back to its pre-recession level by the first half of 2022. But don't forget that GDP is usually growing about 2 or 3% a year. So we'd still be below where we should have been otherwise. And I think, in terms of the unemployment rate, to get back to that kind of 3.5, well, let's say below 4% that we had prior to the recession. I think we're talking 5 or 6 years there. I think it's going to be a long time before we have a really good job market where the unemployment rate is below 4%.
I see. And then which like on a global level, which countries are in the best position to emerge from COVID-19 with a stronger economy?
Well, I mean, obviously those countries that have done a better job of containing the virus and have been better able to reopen. So China, for example, that's where the virus originated. That's where the first outbreaks were, but they did a much better job of containing the virus. Now, it's easier to do that in China, where you have a much more, a more, let's be honest, a more authoritarian government, where the government can tell people what they need to do and so forth. Than in the United States. But even in Western Europe, where I think they were more aggressive in shutting down initially, they have had stronger recoveries, at least starts to recoveries, than in the U.S. So I'm concerned that the fact that we're still having these outbreaks in the U.S., that we have rising caseloads in many parts of the country, that's really going to weigh on what's going on, and that's going to weigh on the U.S. recovery.
Yeah, definitely. So I guess what might, once a vaccine is produced, what might the long-term effects of COVID-19 be on the economy, especially for small businesses? Mr. Faucher, did you hear that?
I'm sorry, I have trouble with you on that one. Oh, you there?
Yeah.
I did not.
Okay.
Why don't you say me? Can you hear me?
Yeah, okay. So the question was, what might the long-term effects of COVID-19 be on the economy, especially for small businesses?
Here I think that, first of all, I think we're going to see big structural changes in the economy. So we are already seeing retail activity, stores move online, and I think that process has accelerated people buying more from Amazon, and that's going to become an even more important part of the economy. I think it's going to, as I mentioned, it's going to take a long time for the economy to come back. That could mean that we see slower economic growth over the longer run, because it's, it takes people drop out of it, they're not productive workers, and so that can result in slower long-run economic growth. We may see some industries, airlines, entertainment, be permanently smaller because of this. We may see less demand for office space. I haven't been in my office since March. A lot of people are working from home. We may just need a lot less office space. So there are these big structural changes in the economy that I think are going to be happening because of the pandemic.
Yeah. So that's all the questions that we had prepared. If anyone has some other questions that they'd like to ask Mr. Faucher, then just unmute and ask them.
Hi, I'm Jenna Isa. I'm a rising junior at Jones College Prep. And my question was, how is your bank or other banks protecting its customers from the impact of COVID-19?
That's a very good question, but I'm not going to answer that because they asked me not to talk about
Okay.
things concerning the bank. They asked me to talk the economy. So I appreciate that question, but I'm not going to be able to answer it, unfortunately.
Okay, thank you.
Any other questions?
Leo, we there?
Yeah. Does anyone have some other questions?
Hi again, it's me. If anyone else has any other questions, I was gonna wait and make sure no one else had already had any questions because I already asked my question. But I listened to Susie Orman
Can
quite
you
often.
repeat that?
Yeah, sure. I'll ask my question. I listen to Susie Orman quite often, and she made a prediction and statement that COVID-19 will, in the long term, in some aspects, help the U.S. economy in some ways and help life in some ways. So, how do you think coronavirus 5 years out, 10 years out, how do you think it will help life, U.S. life?
I'm skeptical. I think the recessions are very bad for people generally. I mean, obviously, people lose their jobs, but young people who are graduating from high school or college will have a difficult time. So I mean, yeah, we'll see some technological advances come out of this, but I think the cost of this downturn are going to be very destructive and very harmful. I've seen harmful effects from the Great Recession that we had a decade or so ago. And so I'm skeptical of that argument.
Okay, so I have a question. Maybe not on the note of COVID-19, but what has been the largest kind of shift in economic consensus that has occurred, throughout your career?
I would say that's a very good question. I would say, first of all, we have had two big recessions in the last. Well, let's put it this way: the two largest recessions since the Great Depression have been in the last dozen years. And so, a lot about how the economy functions, about some of the structural problems that we have in the U.S. economy, and the real costs that have been borne by households. There's been a much greater focus on income inequality and the implications of recessions for income inequality and how they hurt much more than other types of households. And I think that there has generally been a growing consensus, all economists, but across many economists, that it is more important for the government to take a more active role, first of all, in combating recessions, but also in trying to reduce some of the income inequality that we have in the United States right now.
I see. Anyone have any other questions?
Hi, my name is Mia from Jones. I was wondering, how often are mistakes made within the economy and guessing in the future? And is that a common and does it mess up things?
Oh, all the time. I mean, economists certainly, know when, even in late February, early March, when COVID-19 was starting up and was starting to come to the United States, nobody in the profession was predicting the enormous recession that we ended up having. During the Great Recession, a decade or so ago, we knew that there were problems in the housing market, but we didn't recognize the problems that they would cause for the broader U.S. economy, and that we would get a very severe recession like we did. In terms of what the economy is going to look like going forward, different economists have very different views on what how strong the recovery is going to be, how quickly the unemployment rate is going to fall. There's no way, given that our estimates are all over the map, there's no way all of us are going to be right. Many of us are going to get this wrong. And in fact, particularly in the current environment, I've told the economists that I work with, that we need to be humble, and we need to make it clear that there is a lot that can change, and so that we have a forecast and we stand by our forecast, but odds are it's going to turn out to be incorrect, and it can be incorrect because the economy is a lot stronger in a year than we're expecting, or the economy is a lot weaker in the year than we're expecting. But it's a, particularly in the current, is very fluid. I know that I'm going to be wrong about a lot of things.
I see. Other questions before we wrap things up? Okay. Okay, well, if there's no other questions, then I'd like to again thank Mr. Faucher for taking the time out of his day to speak with us, and encourage everyone to attend our next event, the JC University of Chicago Alumni Panel, Sunday, August 2nd at 3 p.m.